for having made the time and for giving up some early morning relaxation in the case of Greta and Beth. And of course, Shama and I are on the same side of the ocean. And we are happy to sit here to talk about what we think is a favorite topic of ours, which is trying to think about doing financial inclusion measurement because it's something that we believe in deeply. And what I will do is I'm going to do a short talk of around 10 minutes. And then what I will do is invite each of you to come in with your thoughts and comments. Each of you also get up to 10 minutes. And if there are any to's and fro's and questions that we have for each other, I think that we should just go ahead and ask them even in the middle of talking. But to each her own. I think that you should just state your preference as you start. And I like to take questions as I'm speaking, so feel free to interrupt whenever you wish. But then we'll have one chance to respond amongst the four of us, and then we will open it up to the floor. And we have about an hour for the discussion. I hope that's okay with everyone. And without further ado, I will start my presentation. Just a minute. Um, huh. Okay, can you see this?
Yes.
Great. All right. So, as the title of the session suggests, it's this entire talk is going to be on asking how we can look at financial inclusion as a problem where we can do better measurement. And it's an old problem, and I think that financial services and financial services and the impact of financial services is something that has been a challenge in terms of measurement from the word go, right? Even before we talked about financial inclusion. Um, Financial services in the beginning, the target was if you wanted to measure whether there was going to be a success in terms of getting financial services. The question was, how do we get more customers into using formal finance? And this is something that we are particularly seized with in India because our competition is the informal financial sector. So our measurement used to be how many customers do you have? What is the size of the assets under management for these customers at financial service providers, who we call FSPs in the stock? And that used to be our sense of, are we getting financial services out to our customers as much as possible? Now, when we come to the idea of financial inclusion, it became into a smaller area where we talk about low income customers. And the measurement was about asking if we are successful in doing financial inclusion. The first cut of measurement was just saying how many low income customers are there amongst the financial service providers who are in the formal financial system, and what is the assets under management of these customers. The problem that we quickly come to realize, because financial inclusion is something that has been talked about as a policy objective, and in the space of policy objectives, we are now beginning to understand that successful policy has to be measured not just in terms of inputs, but there are two other elements that we need to capture when we look at the success of the policy. Inputs are supposed to deliver outputs. And if there are good outputs, then the question is, are we delivering the correct outcome for the policy intervention? So uh, as I started the talk with, the suspicion is that in general, performance measurement in finance is more difficult than in most other areas. So when you think about policy interventions, a very famous example by now of measurement of a policy impact is in the area of education. And this is something that we've learned from India, where the question was, fine, the policy intervention is you build schools and you hire teachers, and that's the input to the policy intervention. You can't say that we have successful education policy just because we've got a lot more schools or teachers. The second level was, is the output happening? That is, when you build these schools and teachers, do you have a lot more kids in school? That was the usage. But the ultimate rock on which the entire policy intervention had to be tested was the outcome. When these children come to school, do they get to know how to read? Do they know how to do the math? And that was education policy. In the space of financial inclusion policy, it is a lot more difficult. So here's where we think about the impact of financial inclusion policy for India. The input is, in India, we said we're going to have these low cost accounts that banks will provide to low-income households. These are called the Jan Dhan accounts. They go to individuals, households. That's the input, right? That you actually get people to open these accounts, or you open it for them. The output was that we should see that these individuals and households actually use the Jan Dhan accounts. Now, if you ask the question, do we get a sense of the number of accounts? We have a report by the Reserve Bank of India, by various banks, that these are the number of Jan Dhan accounts that we have with individuals and households. However, in terms of the usage, the measurement is not so clear. And then the final question of, okay, what's the outcome that we expect when we have these individuals who are owners of these Jan Dhan accounts? That is a big question mark. And I think that what is unique with respect to the rest of the world as well is, if you think about what is supposed to be the outcome of getting people involved or included in finance, what's the outcome that we desire? That's not something that has had a long period of traction. It's a new question that is just constantly evolving in terms of the answer. And we find that it's not easy to come up with comparable measures for capturing financial inclusion if we have to say input, output, and outcome, like we could do for education policy. So financial inclusion policy becomes a lot more murky and difficult in terms of the measurement problem. Now, why do we have to fuss so much about the measurement problem? Maybe to all of us in this group, it is something that we understand well, but I think that it's useful to just open up the boundaries of asking why is it so important. Even with the best of intention, right? We think that measurement is important because it sets a feedback loop for experimentation, that is the interventions, to actual performance, which is what is it that we wish to achieve and are we getting it done? And in financial service provision, that's especially difficult because financial services are things that you consume at a given point in time, and typically the outcomes or the use comes many years later. And because we have this big gap between the purchase of financial services and products to the period at which we are consuming it, the feedback loop tends to be quite difficult to capture. Now, if you don't have it at all, if you don't have a measurement system, then the feedback loop is completely missing. So even if you have the best intended FSPs, this is going to be a difficult thing to capture. Now, when you think about the space of financial inclusion, let's make it a little more complicated, right? So FSPs can claim to care about financial inclusion, but they prefer, in terms of cost structures, revenues, to deal with the better off of the population. And there the question is, these are the better off who can plausibly be labeled as poor. So if you can divide, think about the entire population in a city and you divide them into percentiles by income. If you go to the 15th or the 10th percentile household, they are not the poorest of the poor. The poorest of the poor are likely not to be touched by the FSPs, but that's what they can claim, that we are dealing with a 10 percentile household and therefore we are doing financial inclusion. Investors who invest in these FSPs can claim to care about financial inclusion. For instance, we know that ESG funds are some of the fastest growing asset management classes in the world today. A lot of people are investing in it because they want to show that they care about it. But each of these funds are not going to be individually paying the cost of ascertaining that financial inclusion is actually happening, right? They will have to depend upon the financial services. And of course, the policymakers always favor quick solutions to get quick votes. And for them, pursuing financial inclusion in the truest sense of the term is not going to be something that we can easily visualize being put into place. And of course, compounding the sadness in all the stories, that best intentions are often lacking. And this is what we find that bedevils finance and financial firms and behavior of financial firms all through across the board, right? And so when we think about measurement for financial services, particularly from the point of financial inclusion, the need of the hour is indeed better measurement. And if you think about the state of the art measures of financial inclusion, there's a huge focus on access, which is, do you have bank accounts? Do you have the digital payment app on your phone? And then, of course, there is a lot of thrust on building the awareness of people. So financial literacy takes center stage in a lot of financial inclusion, because that's something that we can actually measure in terms of saying we have educated the people. So we're going back to the education policy where we're building schools. But we also need output, and some of the measures that are out there is available in terms of how many transactions did you see digitally, how much transactions did you see in a period of time. These are the kinds of things that we tend to be able to access in terms of usage. But of course, the outcome in terms of the impact is something that is new and only now being talked about, which is, when people are financially included, are they better off? Do they have financial well-being, economic well-being? And that is something that is still being evolved, right? Now, when I look at the state-of-the-art measures of financial inclusion up on the slide, a lot of this that is available tends to be about the system as opposed to households. And financial inclusion requires household-centric measurement. So it's not about the total number of digital payments in the country. Instead, we should be asking a household or an individual, what were the last 3 payments that you did, and how did you make these? Did you use cash? Did you use a wallet? It should not be about the total number of bank accounts. Instead, if you have a bank account, how many times and in what ways do you use it? It's not about the number of credit accounts in the credit bureau, but the question should be, if you needed $400 in a crisis, can you get it easily? This is a question that has been done in surveys done in the US by the Fed Reserve. And this is the kind of question that is coming into focus. Therefore, when we think about building a financial inclusion measurement system, we think that the desirable features of such a system should be that A, the measures should be household centric. It shouldn't be about the system, it should be about the household. It should capture all 3 parts, which is, what is the input, what is the output, and what is the outcome. That is something that should come out of our measurement system. And if we have this together, what it's supposed to be able to give us the ability to do is to identify gaps across different customer types. So if you have households which are dominated by a woman, a household, the head of the household is a woman versus not, then is that household financially well included versus not, is a question that we should be able to answer if we have a good financial inclusion measurement system. And last but not the least, it should be timely. And that's something that's extremely critical when we think about the why we want to use these systems. The solution that's often in place is we should be able to do it, and we can do it only using household surveys. There are some problems in doing household surveys because some of the desired features conflict with each other. So number one, surveys are costly. Then that puts a constraint on how frequently we can do it. Surveys typically have delayed measurement. That is, you do the survey, you assimilate the data, you clean the data, and then the measurement becomes available, which beats the whole notion of timely capture. There's a big question on what is the outcome that we want to measure if we want to capture financial inclusion. And some of the, as I said, the measures of financial well-being is just coming to light now over the last 5 to 10 years. And this is where our wonderful guests of the evening actually come in, which is recent work at CGAP and Center of Financial Inclusion have got a lot more specificity on how they want to measure financial outcomes. And then, of course, we do need in our measurement system to worry about best intentions and measures. It was Madeline Stratton who basically said, when a measure becomes a target, it ceases to be a good measure. We should not fall into the loop that is often seen in financial service providers, that you set a target and then the individual or the firm just goes all out to max it irrespective of the consequences. And this is something that we worry about in finance a lot. And in financial inclusion, it should be an even greater challenge. Here's a possible approach that we are thinking of, that financial inclusion should be measured as the gap in the income output and outcome between a high percentile household and a low percentile household when those households are put into these slots or categories by income. Then the higher the gap, it should be that it's the worse the inclusion. The lower the gap, the better the inclusion. For example, think about calculating the input, output, and outcome values for the 10th, 25th, 75th, and 95th percentile households in any given sample. It's a function of the sample. Once you decide the sample and you differentiate across geographical zones, or you take the customers of a specific FSP, or the customers of all the FSPs that an ESG fund has invested into, the only thing to focus on is what is the gap between the highest and the lowest, or some of these percentile households, because that is a target where it is a function of the sample, and that is something that's not codified as an absolute target measure, which helps a lot. And it can move through time, right? We can see how it is that this gap changes, and the changes in the gap, whether it widens or becomes narrow, can actually tell us whether financial inclusion measures interventions are working better or not. So it's also, of course, about the frequency. Do we do this once a year, more than once a year? And that's a function of the survey. Regular calculation, of course, will keep the numbers honest. So if we worry about the target becoming an undesirable measure, the more frequently we can calculate this number, the better it is. And I've got a couple of examples in terms of how we can think about this application to test policy. And I mean, I think I'm running out of time, so I will probably skip these two. But both in terms of the application to test policy as well as application to ESG funds, right? The examples are the same, that if we can take the target sample, measure the gap in anything, either it's input or it's in terms of output, a gap in the credit access, for instance, in Bombay, for a first percentile versus a 45th percentile household, this should be the range of samples that we choose to define as financially excluded. And if the range of the values for the credit access for this particular set of households can be the target for an FSP that's applying for funds from an ESG, the ESG can specify what these percentiles are, of course, but that can become one way in which you fix that the FSP is actually providing financial inclusion or not. So in terms of the work that we are doing on this problem at Dwara Research, there is a team of wonderful researchers who are thinking about how to put in place these measures. We are looking at alternative surveys that can be regularly updated, so that if we had to look at measures of input, output, and outcome, it can be a number that we are calculating at the level of the household. The advantage of being a team at Dwara Research is that we have access to partners like Northern Arc Capital as well as Dwara Trust, who have financial service providers who explicitly target financial inclusion. And once this methodology is in place, we can actually see whether it makes sense to these financial service providers, and that can be a validation for our approach. Thanks a lot. And with that set of comments to set the context, can I invite Elizabeth to make her comments to the thoughts and any other thoughts that you may have? Thank you. Elizabeth?
Beth, you're on mute.
Susan, Beth is on mute.
Okay, let me see if I can unmute her. Okay, I can only ask her to unmute.
Sorry about that. Yes, very sorry. So I'm going to put my PowerPoint up.
Yeah.
But I have to get it to start from the beginning. Yeah. No.
You can see it.
There we go. Okay. So yeah, that was great. I really like this your gap concept. I think that's a really interesting idea. I have to think about it some more before I can really respond to it, but I think that's a very interesting idea. What I'm going to talk about is basically what I've been working on, which is how to measure financial health. And I did this work as part of I2I project, the Insight to Impact project, which was a project done out of South Africa. It was managed out of Senfree and Finnmark Trust in South Africa, funded by the Gates Foundation, and the purpose was to figure out a framework for measurement of financial inclusion. And I do recommend their framework. The framework is an access usage framework, and they've done quite a bit of work on how to measure both of those things in ways that work for both policymakers and financial service providers. But they asked me to look at financial health because they wanted to look at the outcomes question. And ironically, what I came out with is while it's important to measure financial health, it doesn't answer the outcomes question. It's not an outcomes measure per se. So we're still thinking about that. But as you were talking, I was thinking about outcomes, and I started, I don't know, maybe this is a little off the wall, but I started thinking about Legos. So what are the outcomes you want from Legos? Well, they're sort of an educational toy. But when you think about, so the direct outcome is children build things. They enjoy playing. They learn some things. There may be some negative outcomes, like the parents step on their Lego and break their ankle. But when you want to measure the success of Legos, the main measure is sales. Who buys it? And clearly you want to understand the way that children use Legos and how they benefit from it, but you wouldn't have to look at that all the time. You would be measuring sales all the time, but you would only be measuring how they look at something once every couple of years, or maybe more often if you want to figure out whether to sell more of the Star Wars Legos or more of the farm animals Legos. But, I think it's a direct comparison here that maybe we're not talking about one system for measuring financial inclusion, but a set of systems in which different pieces of the financial sector are using the pieces that they need the most. But so let me quickly just talk about financial health, because I do think it's important to start measuring it. So I've been looking at how around the world is financial health defined, and it sort of includes short-term finances, the resilience or ability to recover from shocks, and some kind of a perspective about meeting opportunities, and then some kind of feeling of that you're doing okay. And I think this is a sort of a consensus around the world about this is what is meant by financial health. And maybe you could say it as people are in a situation where their management of their finances is going pretty well. And I think that it's useful to measure it because it is an outcome measure, but it's not a very direct outcome measure. It's more of a measure of how are people doing, and the influence of any given factor on how they're doing is pretty indirect. So especially financial services is not, you have so many different factors that drive financial health, from a person's own choices to a lot of just random events, to economic situation, to the quality of the social safety net, that really financial service usage is only one piece of it. But I do think that it's important, very important for policymakers to understand how financially healthy their populations are. And if you do that, I do think that it's possible to use the information to develop products and services that support financial health. And a lot of people use it to look at their financial education and financial literacy programs. And when we do know that people are not financially healthy, and there is a very disappointing result of, yes, people are much more financially included than they used to be, but their resilience is not going up. And we've seen that in the Global Findex, which asks the question about whether you could come up with funds in an emergency, which is sort of seen as the number one financial health question. Can you come up with funds within a month? And the funds are scaled to the level of GDP of the country in which the question is asked. And about half of the world's people say that they can. And in low-income countries, it's much lower. But so we know that there's a problem. And I think that the COVID-19 really emphasized how this resilience issue is just front and center in what we need to be able to be paying attention to. This graph shows you how quickly people deplete the resources based on sort of a slight revision of that question of how much resources, how far can your resources meet, your current resources meet your daily needs if your income disappeared. And really, you know, by the time you've had 3 months of lockdown, virtually everybody in low-income countries is depleted. And so what we have now with the COVID-19 situation is that everyone across the globe has depleted their reserves, and we really need a concerted effort to work on what's the strategy for helping people build back their reserves. And so clearly financial health is going to be a very important aspect of looking at whether we're recovering well from the pandemic. There's a lot of work going on in financial health in high income countries. So we have a whole, in the UK, they've created a whole service called the Money and Pension Service that's really focused on, they call it financial well-being, but it's the same thing. And it's really focused on promoting financial health. In the US, the Consumer Finance Protection Bureau has been very, very active in measuring financial health, developing tools for people to measure financial health, both individuals, financial institutions, and policymakers. And of course, this famous Fed question of $400 has been hugely important in shaping the debate over economic policy in the United States. The Financial Health Network is a nonprofit that does much the same thing. Now, in developing countries, we're seeing financial health begin to get some attention. And at least the countries that are listed there, Kenya, Mexico, Brazil, Peru, and the Philippines, have all done surveys to measure financial health. But it's still at a very early stage. And I think the question of, so you've measured it, what do you do about it, is still very much an open question. So here's what I kind of think that should be happening. I think that policymakers should be considering financial health as one of the objectives that they would like to see, in recognizing that they don't necessarily have a direct channel to make it happen. I do think that they need to start measuring it, because when you ask this set of questions about your financial health, you get insights that are really not captured by the standard socioeconomic variables of income. And they're a lot more relevant to financial inclusion than the regular socioeconomic variables. So I think they're an important addition of insights. But again, just to reiterate, I don't think you can't think of it as, oh, let's measure financial health and then we've solved the question of outcomes. And finally, I think there's easy and hard ways to measure financial health. And you do need to do a little homework to get to a point where you could use a quick and easy index to measure financial health. And I wanted to just show one example of, here's an example of an index that I think captures the measurement of financial health with, it's based on the four key elements of financial health that I mentioned at the beginning. I think the last thing I would want to mention is that there's an increasing amount of information on using transaction data to measure financial health, or to use a combination of surveys and transaction data. And for example, BFA in Mexico is in the middle of doing studies on finding the types of transactions that are signals of financial health issues. and for example, missed payments or borrowing for consumption is one of the things that's the a big signal. So that work is going on. Also, I think another place to look is the Commonwealth Bank of Australia. They have terrific resources. They've done a whole lot of stuff, and they've also been looking at how to combine survey questions with questions that are derived from transaction data. And I think the Financial Health Network in the United States has been doing the same thing, and their current report, their most recent report, has the results of some of that. So I think that bottom line is it's time to start doing this measurement, but don't think of it as the solution to the outcomes problem. Susan, you're on mute. Maybe.
Sorry. Yeah, no, I was on mute. It is true. I had a quick question before we go across to Greta. The one thing that we are beginning to understand is that it's all very well to do, as you said, do one of the survey, do it at one point in time, and then we've solved the outcomes problem. But we haven't, right? How many of the policymakers that you're talking with get the sense that it needs to be done on a regular basis? Because perhaps it's that in India, we have a lot of interventions that are being put in place all the time, or that the business models are constantly evolving. But we are seized with the importance of doing this on a regular basis, on a continuing basis. Is that something that everybody around the world is thinking of as well?
I have not been hearing people worry about trying to capture short-term changes so much. With COVID, there was a lot of I think BFA called it a dipstick, the surveys that they did, and I think it was an appropriate time to use that kind of quick in, quick out survey. But at the same time, there was a loss of quality to that survey approach because so I don't think that they were able to capture as much nuance, and I don't think they were able to be as reliable about the validity. So I would say that more frequent is not something that I've been hearing a lot about, other than in the context of the pandemic.
Okay, thanks a lot. Greta, can I invite you to give us your thoughts and comments?
Yeah, and thanks for inviting me to this conversation. I think this is really timely and it's a really important topic. So I'm glad to sort of be involved in this discussion. And a lot of really interesting things said, most of which I completely agree with. So let me maybe just kind of give you some thoughts from the CGAP perspective, and then maybe we can have a little bit more of a discussion. So at CGAP, we've sort of felt for a while that we needed to move beyond this access and usage paradigm that's sort of been the defining feature, at least for the last bit of time in the financial inclusion space, because what we wanted to do is move from access to usage and then think about sort of capabilities and resources and then think about outcomes. And so we're really on board with financial health as a metric, but I think what Beth was saying, we agree with. I think it is part of that outcome, and we've done a lot of work on outcomes-based consumer protection, most recently in South Africa, but I don't think it tells the whole story, because what we want to see is development outcomes. Like, how is it contributing to improving people's lives? So we've defined that for ourselves and are digging into this topic-wise in terms of thinking about, okay, how do financial services contribute to people's ability to generate income? How do they contribute to people's ability to gain access to essential services? And how do they contribute to people's ability to build resilience, which speaks more to the financial health side of things, right? And so we're trying to look at this in a much broader way, and we're really only just digging into this now, and we'll probably have a lot more to say on it soon. But I think there's something, maybe a couple of loose thoughts, and then I'll get into the main part of what I wanted to say. I think we do have to sort of think about a couple of definitional things as we talk about this, right? So first of all, there's very loose usage of this word financial inclusion. And it doesn't always mean poor people. And so I think we have to sort of keep that in the back of our minds and understand exactly what we're aiming at here. I know that sounds really obvious, but I see so much overlooking of the cash in, cash out question. And it's just so fundamental to bringing people into the financial system. As far as the World Bank's concerned, it doesn't even exist. Distribution's not a problem, right? If you have all that fancy infrastructure in the middle, so what? It doesn't work unless people can do analog to digital and back. And so I think we do have to think really carefully about what inclusive finance means. And I think we also have to think about, sort of qualitatively what inclusive means. And you asked earlier about how, impact investing sort of affects some of this. Well, it does, right? If you look at what happened with digital credit in Africa, everybody's really happy. They're getting a return, huge amounts of credit growth. Is that good credit growth? Maybe not, right? And so I think we have to be really careful about how we use these terms. I think there's also an interesting challenge in our space about which financial service are we talking about? Because I think there are different impacts of different kinds of financial services. So the answer for payments might be very different than the answer for credit, insurance. We probably don't want universal credit coverage. I think we do want universal payments coverage. And so I think that adds another layer of nuance that may not be there in some other areas. But, speaking to kind of the high level kind of questions that you're asking, I think we have to start with what objective we're trying to achieve on measuring financial inclusion, right? And I think we have some tools that are really good, but there are obviously gaps, right? So I think if we want to do cross-country comparisons, I think the Findex is very good. Household surveys, it allows us to sort of chart progress every 3 years, except for this year, because it's difficult gathering it right now. But, and compare across countries, and that's really, really valuable. And that tracks really nicely against what the GSMA does. That may not be so relevant in India, but it's massively relevant in Africa. So, and the nice thing is that you've got a supply side data set and a demand side data set, and they track against each other pretty well. And so I think those are really useful tools, but they don't give us the whole story. They tell us a lot about access. They tell us a fair amount about usage. They tell us almost nothing about outcomes, right? And I know Leora, really has been wrestling with this and how we think about getting at outcomes. There's the financial health question, which is the $400 equivalent question, but it doesn't tell us that much about that. And I think we may have to use other tools to get at some of those questions. But so, cross-country, global comparisons. Then I think country level data is really important. And there are lots of tools for gathering country level data. So we've got the FinAccess surveys in a lot of Africa, and that gives us more routine, regular kind of data points from a demand side perspective. But there's also, I'm always really struck by just how little supply side data there is. So I did some work looking at credit markets in Africa and how credit markets were developing, and stumbled upon this amazing data set that FSD Africa had worked with the government of Zambia to pull together. And what that revealed was, it just so happened they started it right at the time digital credit was taking off. And what it revealed was that there was about 1.6 million digital credit loans, basically credit card, kind of short-term, very expensive consumer credit, that had been issued in, I think, a quarter. 60% of that was going to the lowest income households. And then you compared it to the data they had on micro and small loans, and it was something like 3,000 in the entire country of Zambia. So that tells you there's something out of whack, right? But then I asked around and I said, hey, do we have this in Kenya? We don't have it in Kenya. We don't have it anywhere. We have a few bright sparks. Peru has amazing supply side data, but they are so much the exception rather than the rule. South Africa has some, but we really don't have good supply side data on what's going on in how far financial markets are actually reaching people who are not, kind of mainstream corporate government, whatever. So I think there's actually not enough focus on country level data gathering, and that's probably an area of some attention. And then there's, of course, the company data, right? And so we've had the mix for many years that looked at the microfinance sector. The off-grid energy sector is actually moving towards having pretty good data sets. We've worked for a long time with GOGLA on performance indicators and what meaningful indicators are. And trying to make consistent across that industry what kinds of financial performance indicators are meaningful. And that, I think, has been a useful exercise. Then we have this whole crazy world of fintech. And if you're an impact investor, you don't know what the heck to do with that, right? Because there are no comparators. It's people just don't know how you're comparing apples and grapefruits. And so I think there's still a lot of work to be clear about that, but I actually think the bigger challenge in the fintech space is understanding, well, is this fintech just making something work better? Is it about scale among, rich people? Or are we actually reaching low income people? And we have some work coming out soon on how investors ought to be thinking about impact in the fintech space, given how dynamic and how fluid it is. And so I think all three of those levels of data are really important. I think there's a fourth, which is about using evaluation methods, mixed methods of understanding what the impact is. Because I think it is really hard to build into some of these more monitoring type data sets what the actual impact is. That plays out over time, right? And we're also kind of taking a look at this because I don't think we have a very clear picture, right? I think there's pretty strong evidence that savings and insurance are pretty impactful products and they really matter for poor people. There's a growing body of evidence around payments. Microfinance has always had this mixed record, right? Like, does it have an impact? Does it not have an impact? And all the randomises have come in and opined on that. We haven't nailed this completely down, but we kind of took a look at the credit impact evaluation space and discovered something really interesting, not for repeating beyond this group because we still have to nail it down, but it looks like those evaluations, none of them took place in Latin America that we can find. None of them looked at individual lending. So like they're missing huge parts of the microfinance industry, and possibly the parts of the microfinance industry that the evidence base right now suggests benefits from credit much more, which is the more organized, more sort of the kinds of entities that would benefit from individual loans rather than group loans. So we're trying to dig into that and see what's really under the hood. We're checking in with a bunch of people going, really? Nothing on Latin America? But anyway, I think there's going to be some interesting things coming out of that. But I think that evaluative base, that qualitative research and connecting that with the broader financial inclusion story is also really important. And we have to kind of get organized around that again. A couple of other quick thoughts. I think, India is a little bit different than a lot of the other markets I work in, but I think there are a few really important factors we have to think about in terms of this. One of them is cost, right? I mean, poor Leora is always going around cap in hand trying to get money for the Findex. And the Findex is one of the most valuable tools we have right now. And, the GSMA is kind of supported in their work by the Gates Foundation and others, but that funding is really tenuous. And Exhibit A is the mix. They had to stop doing that data set because nobody was willing to pay for it anymore. And so I think when we create these things, we have to be really careful because their value is in doing it over time. In that objective. And so I think we have to be really thoughtful in terms of what we ask or what we try to put out there, because otherwise we lose people and they go look at some shiny new object. That's one. The other one is capability. You look at Zambia, it took them 3 years to cook up that data set. And it was a lot of work, right? And a lot of support from FSD Africa. So it's a big ask to get people to produce the kind of data that Peru provides at the country level. But you know what? Supervisors and regulators have that in their power. So, I think there is a real conversation to be had about the value of gathering those sorts of data sets, but we also have to understand that there's not always the same kind of capability that you've got sitting in India. And then there's a question of consistency and comparability. I think some of the individual country studies, a little bit the challenge is, well, how do I stack up that information from Zambia against that information from Kenya or another country? And so, I think having sort of a collective theory of change about what data can do for us in terms of both policy and an investment decision making would be really useful, because it would help sort of create more of a data architecture that we can think about. One thing, and then I'll stop, is I know the World Bank is looking at what they can do on the data side. Financial services isn't front and center in it, but I think there is a real opportunity right now. And what COVID's shown us is there is such a huge need for data sets that can be developed over time and that can be used for decision making. And I think now is a really good time to engage with them on what they might be able to do. So I'll stop there, but I'm really interested to hear what others have to say.
Thanks a lot, Greta. A lot of food for thought. And before we open up to spreading it around, can I invite Shama Fernandez to give us her thoughts on what has been discussed so far? She's the person on the ground fighting this battle on trying to make sense of who's a good guy, who's a bad guy, who to work with, who not to work with. So Shama, the floor is yours.
Thank you, Susan. Now that you know what I look like, I'm going to switch off my camera so I can conserve some bandwidth and don't get cut off in the middle. So I hope that's all right.
Okay.
Okay, cool. So, I mean, I pretty much agree with everything that has been said, and I think this is, I think the conclusion I've come to, and it's something that I've been thinking for a while, is that really when we think in terms of a financial inclusion index, I think there's a need for a holistic approach uh, towards constructing such an index or towards understanding financial inclusion in itself. Which is really why it makes me think that the family as a unit and survey as a tool can be very, very powerful, because it can end up getting very, very nuanced in some ways. So let me kind of look at what would be the end state of financial inclusion, and in some ways, both Beth and Greta did define how they see this. But the way I look at it is basically the ability to really control / build financial predictability in one's life. That's the way I would look at sort of the end state one wants to achieve if one is talking about a financially included household, geography, country, nation, whichever way you want to look at it. And of course, financial predictability can come through a variety of measures, right? So basically payments, access to savings bank accounts, access to credit, access to insurance and risk management, access to investments and wealth creation, and finally financial planning. So you're looking at a whole suite of products and tools that will allow you to sort of get to that ability to control / build financial predictability in your life. But this is easier said than done, because the minute you kind of bring on board all these multiple products, it becomes more and more complex. So when you look at sort of data sets and so on and so forth, I think one of the, as I understand, the disadvantage of data sets is that they do tend to get fragmented, and they do tend to look at one particular type of excess. Whereas in the true sense, I don't really think from a family perspective or from a true financial inclusion perspective, you can really bifurcate excess into, do you have credit excess? Do you have payments excess? Do you have access to a savings bank account? But because it's really it's one household, it's one individual. And there is a lot of interchangeability in terms of how households actually use these products. So it's very well known that microfinance is often used as a substitute for not having access to a savings bank account. It is very often used as a substitute for an insurance product, where, I mean, the family goes through a financial crisis, there isn't access to insurance products, so you borrow and then you sort of deal with that situation. So what I'm really trying to say here is that financial inclusion in itself is a very complex thing. And if we really sort of want to really understand that complex animal, then we really need to look at these multiple financial products and then see how they all come together. And if at all there is a way for us to measure all of these together as one comprehensive index over a consistent period of time, I think it's a hugely challenging task. And I don't see any simple answers to this. And really the point is that, while delivery can actually be fragmented, right? So basically you could have a separate payments provider, you could have a separate savings bank provider, you could have a separate credit provider, and so on and so forth. The recipient really needs to be looked at in a sort of, I would say, a holistic manner. So I think that's one big point I'm making, to say that, it's great that, as the more the data we have, the better we are. It's better than sort of having nothing, and really we are very close to nothing in many of these areas. But is there a way we can sort of look beyond that and see if there's something comprehensive that we can build? That's one part. The second point, and I really have only 2 points to make here, because a lot of what I had in mind to say has already been said. And I have no major disagreements with anything that's been said. The second point is really, Susan, your kind of structuring this in terms of input, output, and outcome. And it's a very nice way to look at it. And, I kind of agree with that approach. There's just a small distinction that I want to sort of make here in terms of how one looks at input, output, and outcome. And for just sort of making it simple, I'm going to use your school example. So, in the case of the school example, we talk about the availability of the school and teachers and so on and so forth. So that's your input. And the way I'm looking at input from a financial inclusion perspective is really the ability to create products targeted at the segment. It is not the delivery of the product. It's just the creation of the product, which is the input, in my opinion. And let me just give you a sense of what I mean here. I think the creation of the Jan Dhan account infrastructure is the input. It's a very, very important input. It's not the end, but it's a very important input. Something that's probably more relevant in current times is, something that we kind of tried doing during the initial period of the COVID, pandemic. So, we basically took COVID insurance for all our employees, and then thought, why not extend it to our clients, which is basically, the microfinance borrowers, small business loans borrowers, and so on and so forth. And because we had this really nice policy that was provided to us and our employees, we said, why don't you structure a policy for our borrowers, and then we will use our CSR money to really pay for them. So they don't have to pay for it. We will pay for it, but just structure a product for us. And we made it very simple for them to say that make it a parametric product. So it's 0-1, that if in the event that a particular financially excluded borrower or a low-income household gets infected, then there is a parametric outcome. So there's some cash flow that comes to them straight away. So it's not about hospitalization, bills, none of that. A very simple product. Now, the funny thing is, after multiple negotiations with multiple insurance companies, we ended up in a situation where no insurance company wanted to insure that in that sector. So this is really what I'm saying, that just getting that core infrastructure in place is the input. And that's really the distinction I'm making, Susan. To me, the input is not using a Jan Dhan account. Input is actually having a Jan Dhan account that somebody who's financially excluded can access.
Okay.
And then again, just sort of extending that example, right? So the output, as you say, is children in school. My output would be a no frills account that is actually being rolled out to a client. And if you extend that logic, then your outcome really is the usage of that account and so on and so forth. Now, this is only for one thing we're talking about, right? Which is an account. And you sort of build that complexity into multiple financial products and then bring them together and then think about constructing, an index that measures, are you financially included or not? To my mind, it becomes a very, very complex exercise. And I don't see how one would do this without, potentially using a very high touch survey approach. And like we said, that's a very expensive proposition. But, I don't know how else to do this. And broadly, if you look at how indexes are constructed from a financial inclusion perspective, we're looking at two types, right? So one is basically the Findex type of index, which is more sort of an aggregate global index. You're using it to compare one country versus other. But what we're really talking about is really looking at one family versus another in the Indian context. It's like Susan said, the gap in the family structure, the gap in the haves and the have-nots. So I think I think for that kind of an approach, what one really needs is a more holistic index. And to my mind, it's a very, very complex exercise. I will leave this to Susan Thomas. I have no idea how one goes about doing this, but I just wanted to give a sense of how I'm looking at the, the requirement of constructing a financial index. And my last point, at Northern Rock, we do credit, and, we use very, very simplistic measures for impact. We use very simplistic measures for financial inclusion. One of them is the quantum of financing we provide. The other is the TAT for delivery. How quickly can somebody who approaches us get the product they require? And then over a period of time, what is the reduction in costs that we've really produced for that individual institution, whichever way, business, whichever way we're looking at it. But again, very, very narrow approach. And sure. I think what we have in front of us is really a humongous task. I'm going to stop at that.
Thanks a lot, Shama, and no thanks for having passed the baton on to me. But yeah, since I'm the researcher in the group, I suppose that that's the job that we are supposed to take on board to say it's a complex problem. I agree with you. But the one thing that I do want to place on the table before we go forward is that we don't necessarily have to think about this as a single number, right? We can actually have multiple indexes or multiple measures, perhaps one single one for every different factor or every different type of product, perhaps one for just inputs into the financial system. So my sense is that it might make more sense to think about a complex of measures to suit the complex problems that we are talking about. I'm going to throw open the discussion to the floor. So people, I can see that there are several questions that have been and comments that have been put into the chat box, as people have been calling it. And I think that several of these comments have been answered. It's useful stuff. I hope that we are able to capture all of this. But if someone has got a question that they want to place to the panel, please do raise your hand / put a question up. Anybody? So I have one comment to place to something that Greta said, and I think Shama for you as well, right? The way that we are beginning to think about the outcomes of finance, and Greta mentioned this when she talked about credit, and everybody talks about this when they talk about credit, right? Like, what exactly is it that we are expecting to see? So Greta said that the more important thing to see in the space of credit as a financial product or service is that we should see an increase in the income and improvement in the likelihood of the household or the family. Our thinking from first principles is that the first and foremost function of, or the outcome that we would expect for finance delivered to people is something that Shama said, which is that their income and their livelihood and their plan and what they expect to spend is something which is, sorry, I think that my floor cleaner just started. Sorry. I mean, when AI takes over your life, it can actually go haywire. People who are watching this video, please take note. But to come back to the point about financial services and products, the first and foremost financial outcome that we would expect is that people's consumption gets a lot more stable. Okay, and right now we are not. This is not something that we have ever visualized. Asking people, right, is your consumption more stable? I think Beth will point out that there is the ability to plan for an expenditure and have your income match it is one part of financial planning, and that is something that we seek to measure. But my suspicion is that a good outcome measure is, first of all, to get smoothing of your consumption. The second one is, how do I increase the livelihood or my level of expenditure? So Greta, I would say, I would push back on the comment that for credit, we have to see an improvement of livelihood. My first thing would be that, and we see this in poor people's borrowing patterns all the time. It's not like they're borrowing to make an investment or to start a business. Typically, low-income households are borrowing because they need to smooth consumption. And therefore, I think that this is something that we are slowly beginning to realize through umpteen research papers that have been done. But this is a two-point objective that if we expect that a household is financially included, the first thing that we would expect is that they are able to smooth consumption no matter what shocks come. Their consumption does not get perturbed. And the second part of it is that if there are certain kinds of financial products and services like credit, we would expect that first their consumption is smooth, and once it is at a steady level, then there are financial services and products that help them to come to a higher level of expenditure. So I mean, right now it's still a research problem that we are trying to put together. But our thinking on inputs, outputs, and outcomes is that if we are able to do a survey questionnaire and figure out how to do this, as you said, Greta, it has to be something that is consistent, that from point 1 to point 2, no matter who's the survey or the sample that we pick up, it needs to be necessarily comparable. It's no point doing a high frequency survey, which is very expensive, if at the end of the day, we don't get a measure that we can use to say, okay, the financial inclusion actually improved or worsened from one point to the other. So that's one problem that we have to solve. But at the end of the day, what we have to measure it against is another, maybe an exogenous variable that tells us that for the households that appear to be financially more included in terms of either input or output, or both necessarily, their consumption is something that is a lot more stable as compared with those households that do not appear to be financially included. And I think that's the first port of call. The second port of call is to say, for those households that are financially included, are they over time able to see an improvement in their livelihood? So that's the kind of approach that we are trying to put into our analysis and our framework. And it'd be great to hear what you think about this.
Susan, can I come in on this credit point? Because I think you've put your finger on something really important around that. I think essentially that's the point I was trying to make. First of all, any given financial service like credit is used in different ways, right? So people will use digital credit, like we use a credit card. Oh, I don't have money this month. I'm going to run up a balance. It's more like we would call it a resilience product. That is sort of putting a floor under somebody. But I think credit's also used to grow, and that's why, I think that's precisely why the evidence base is mixed, right? So if all you're doing is looking at group lending in certain contexts, then you're going to get certain answers. And it may not be that those contexts are using credit for growth purposes. But if you take a micro enterprise in Peru that's got an individual loan and multiple loan cycles, that might be precisely what's going on. And so in a way, what we've done is we've put all these different kinds of microfinance institutions, which run the gamut from large banks in a country to little NGOs, and sort of called them the same thing. And they're not. And then, that's just credit. Then you get into the interplay between, say, payments and credit. And so it becomes much, much more complex to kind of pull apart those different strands. So I think there is a need to kind of take a new look at some of these things, because I feel like, we're going around as an industry saying, oh, the evidence base for credit is really mixed. And then you go, well, wait a minute. like we were just floored when we took a look at the evidence base. I don't know why we hadn't before. So I think it is really worth kind of examining what we think the theory of change is and the pathways for these different kinds of products.
Also, I think that you mentioned this, right? That when we do something like a measurement system, it's important to have clarity on what the objective is. And I think that one of the things that we realize, and this is because partly we've been in the world of creating measurement and indexes, although completely for a different part of the world, right? We've worked in equity markets and equity market indexes. The objective there was to pinpoint who would be your target audience, right? Because if you're a policymaker and you want to look at financial inclusion measurement, your focus will be slightly different as compared with if you are an FSP and you're looking at how do I identify gaps in the my customer base or outside the population who can be my potential customer base, and figure out how it is that I can put a measurement system to identify the people who are excluded and then provide services to bring them into my customer base. So I think that it's likely that the kind of approach that you would use. So for instance, for the FSP, I'm presuming that they would like to see a much more high frequency of measurement because their business models are under their control. They can actually change this stuff. They want to know, say, for instance, when COVID happens, which is the first area that they should go and target their advertising to or send their marketing teams to, right? So for them to be able to identify the opportunities from the point of view of where to target, my sense is that kind of a measurement system needs to be a lot more real time as compared with, say, a policymaker who knows that whatever intervention has been put in place, it takes time for the effects to come out. And therefore, they are okay doing it once in 2 years or once in 3 years, right? Or a much more stable environment like the US, or as Beth mentioned, once in 3 years is okay if you don't have that much evolution happening or that much growth happening. So my sense is what we are trying to get at is what can be a methodology which is relatively simple for an FSP or a policymaker. The FSP has a captive audience. So to a certain extent, that firm can go and deploy the measurement system on their own customer base because they've got a lot of the information already. And then they can put together the numbers and ask, okay, which part of my customer base is financially included versus not, vis-a-vis my own product. If I'm a bank and I'm doing fixed deposits of a slightly longer term, I can test for which of my customers do not have it, and then how can I see them improve either the output or the outcomes, right, for the customer base. So my sense is the methodology is likely to have different hues depending upon what is the objective. And so I think that hearing Shama speak was quite an eye-opener because we tend to think about researchers and the policy angle, whereas she's on the ground. And for her to come back and say, look, I'm seeing input and output in a slightly different way, tells us that the methodology of the measurement needs necessarily to focus on an objective and go out. And that's the task that we have taken on ourselves, that we are lucky to be sitting in an environment where people like Northern Arc Capital and Dwara Trust are interested in having their customers engage with us to talk about how to build these measurement systems. And I think that we should have some work to show by the end of January, and we'd be really grateful to get comments and inputs from you and from Beth on what you think about some of this stuff.
Can I just comment? I look forward to seeing what you come up with. I just wanted to talk a little bit about indexes and what I think an index is about. And you know, the first index that I was widely or used a lot was the Progress Out of Poverty Index, the PPI, and that was a result of attempting to come up with a way that very quick on the ground measurement of poverty could take place in a way that was linked to the deeper household surveys. And so, you know, the analysis was to do a lot of testing of various questions and how predictive those questions were of the overall poverty results of a household survey. And so what's happening now in the financial health area is the same thing, where you've got this very detailed set of questions about how somebody's running their financial life, and then there's a lot of, and I forget, you know, it's these technical terms that I don't know, but you probably know what they are, but the analysis of the predictive power of the different questions, and so once you've done that and you've selected down to five or six questions, then that you know are very predictive, then you can stick them on an app, and you can get answers all frequently as much as you want. You can have people do it because they want to get their score, and that is what's available in the U.S. now. That there's many apps where you can, you know, test your financial health, you get a score, you know, you get some advice, and so people are interested in doing that. But it also enables financial institutions to very easily take the temperature of their clientele, and for policymakers to sample populations much more frequently.
No, I mean that's a fantastic input, and that's why we are hoping that the financial service providers, who are probably the people who are most interested in this, should be the ones that engage on this measurement problem. But this is something that we are waiting to evolve to see. But thanks a lot, Greta. That is a useful input. We should take a look at the PPI questionnaire just to see about the simplicity of the questions that are faced. I know that there are some people who are deeply interested in this space. Bindu, we haven't heard from you. Any thoughts, comments?
Susan, I think Bindu has logged off.
Oh, okay, cool. No problem. I thought I just saw her. Anybody else? Renuka, any thoughts? Josh?
Susan, I had a question / comment.
Go for it.
Yeah, so I mean, maybe I'm jumping the gun at this time because we've not yet reached a stage where we can build a measurement index to build a measurement. But I'm not sure next time when we'll get all of the, you know, Greta and Beth in the same room. So once we have the measurement, and because in US and Australia, they started the work back in 2014 to 17, how do we end up, you know, convincing on a regular basis the FSP that, you know, use this, and this is what is an actual indicator for the extent of financial well-being of the clients you are already serving. But these are probably, you know, things that were there, but you haven't been able to see it because you were not measuring it. So how do we convince the FSP on a consistent basis after we've created the measurement?
Greta, Beth, Shama?
I have to get off the call.
My only thing is to make it easy, is provide tools that make it really easy for an FSP to do it.
Sure.
What I was going to add is the Financial Health Network here in the US, they did a lot of work on this topic, and they have a lot of resources because they found after 2008, the crisis here, a lot of banks really understood the need to pay attention to that. So they're a consortium, they're a membership organization like we are, but their members are financial services providers, and they're embedding this into their work. So it's worth checking out their website. I think they have a lot of good resources on it.
Sure.
Yeah, Susan, in a country where priority sector lending is still, one of the powerful tools used to actually lend to financially excluded sectors, I think unless there is some element of really making sure that there is financing associated with this, it'll get difficult. Or rather, associating this with financing will make it easier. And it's really happening. A lot of the impact investors are today very, very concerned about what is the impact of their money, and they make it mandatory for financial services providers to measure that impact. So I think sort of making sure that all of this goes together, and you have more and more of financiers, impact investors on board, perhaps even as you develop the index, so that you get inputs from them in terms of what it is that they're looking for, might be a way to do it.
Okay. No, this is great. This is fantastic. But we're running out of time. This always happens. But thank you so very much. You've been a brilliant panel. Beth, Greta, Shama, from all across the world, our heartfelt thanks for your having taken time out of such a busy set of schedules. And we are hoping to get back in touch with you because we're in love with the subject. And I'm hoping that we'll be able to engage. Thank you all very much. And
Thank you. It was a fun conversation.
Thanks, Rita. So we'll catch up tomorrow. For those of you who are here for the Emerging Markets Conference, we'll catch up tomorrow. If you don't have the Zoom link, please send me email and I'll send it to you. Thanks a lot. Bye.
Bye.
Thanks, Greta. Bye. Thanks, Shama.